Welcome, everybody. Steven Sitkowski here. Welcome to my Building Wealth podcast. It is the 13th, yes, indeed, of July. Hope you had a fantastic weekend. Um, Ours was pretty great. Saturday night, went to go see My Fair Lady. I could have danced all night. For the life, man, I don't know why they didn't pull me in and ask me to do a couple of numbers, but anyway, it's fantastic. Local playhouse here and Sunday night, dinner with friends. Then I wake up to the news that we are again doing battle with Iran, which is driving the markets down and oil prices up. And it's just another day, you know? Our job is to control what we can control. And that's what we'll be talking about. So, very glad to have you back. Let me go ahead and share my screen with you. It got to be 107 where I am. And I'm in the mountains, not way up in the mountains. I'm at 5,100 feet. I'm up far enough that you wouldn't think you'd be dealing with 107. High today is only going to be um, like 100. So that's not too terribly bad. Little bit of my history. If you're new to me, I've been working with people and their money now for 45 years. During that period of time, I have trained somewhere in the neighborhood of 1.5 to 2 million people. That is my best estimate. Kind of stopped keeping track. I don't know, a couple of decades ago, but it's been a lot of folks. And I absolutely love taking things that I've learned over the years and being able to share them with somebody else and then watch their lives get better as a result. It's a pretty amazing thing. I want you to know that everything that we do here is for educational purposes only. It is not intended as investment advice. And even though I will comment from time to time on particular stocks or trades, I'm not telling you to run out and buy or sell something. I don't know anything about, your circumstances, risk tolerance, etc. By the way, I am going to be taking a look at two stocks on behalf of somebody who emailed me, wanted to know my opinion. So we will definitely be checking those out. And before we're done, I'll give you my email address if there are topics you'd like to submit to me or questions that you've got or stocks you want me to take a look at. Always happy to do that. I want to make you part of the show. So, what is moving the markets? Well, markets are down due to this escalation. So, as I'm recording, this is Monday, and we are um, at about 11 o'clock Mountain Time. Um, the Dow is down 158 points. S&P down 0.61%. The Nasdaq down 1.25%. The Nasdaq 100, which are the 100 largest companies trade on the Nasdaq, down 1.58. Russell 2000 is down 0.81. So all indices are down across the board, and that is all directly tied to this latest escalation. So I understand that the US and Iranians exchanged airstrikes on Sunday. What a way to celebrate a Sunday, huh? And then today, Trump called for a blockade again on the Strait of Hormuz. So oil prices and interest rates, as you're going to see, have moved higher, which causes the market to move lower. The market doesn't like higher oil prices unless you're an oil stock, because they generally lead to higher interest rates, which the market definitely doesn't like. Chip makers are selling off, hence the NASDAQ. So we'll take a closer look at that. Keep in mind, there's been a ton of money that's been made year to date with these chip makers. So when people start getting a little skittish, what are they going to sell first typically? Places where they've got big profits. They get concerned that, hey, can this keep going up? I might as well go ahead and book my gains now. We've got major earnings announcements coming out this week. So we're going to be starting with some of the big banks, and I'll give you a list of a few of those to watch. These are potentially market movers. And it won't be so much, in my opinion, the earnings announcement itself. It'll be their comments about the economy and the consumer, either to the plus side or the downside, that could move the market. So it's going to be worth listening to those comments or at least reading about them. 10-year Treasury is up to 4.597. So I told you when we go above 4.5, the market gets a little grouchy, and it has. If we go above 5%, it'll be flat pissed off. Market will pull back 5 to 10% in that event. Hopefully, it won't get there, and I don't think that it will. But, we always got to be looking ahead. Oil prices jumped to 74.57. A week ago, we had this down to like 86. And it's like watching kids out on the playground that just can't get along. I can hear the teacher, can't you just be nice to each other? But apparently not. It's like we have a deal with Iran, we don't have a deal. We have a deal, we don't have a deal. So we just got to follow this day by day and watch how the markets respond, because that more than likely is telling you what's really going on. So that's what's driving the markets. The scoreboard as it relates to some of the sectors. So if we were to look at, and let's make our focus, percentage with 4-week highs, communication services up 17%. Energy, I almost want to throw this out because that is obviously, war driven. But financials, you've heard me say to you that financials, which has been lagging, I believed represented a good value, right? Low multiples, decent, um, decent dividends for a lot of these companies, a good place, I think, to hang out. So finally, we're starting to see a little light finally being shown on the financial sector. It has been a while. Last week's market breadth. Okay, this is very telling. So, a couple things that we want to look at: advancers versus decliners, companies hitting new 52-week highs versus new 52-week lows. So, we have the New York Stock Exchange. On the left, we have the NASDAQ, which will be tech heavy, on the right. So when it comes to advancers versus decliners, 1297 going up, 1552 going down. Not horrible, but obviously not great. Companies hitting new 52-week highs, 254, lows, 114. That's terrific. 2 to 1. So I would definitely still be bullish. When it comes to the NASDAQ, 2378 higher, 2826 lower. New highs 477, new lows 390. Not as dominant as on the New York Stock Exchange, but still pretty strong, no denying. More hitting new highs than new lows. So market breadth, I would say, is moderately bullish. How's that? or cautiously bullish. Friday's big winner, Meta. So Meta announced last week that they're going to start selling computing space. So that'll be interesting to see how that goes. They were up 6%. Nvidia for the week up 4%. Nike up about 4%. Those are probably the biggies, the ones that be of most interest to the majority of you. Last week's heat map. So you can see a fairly decent balance between the green and the red. Looks like, in terms of sheer numbers, we had a bit more red, more stocks that were down. But on the stocks that were up, we had some that were up pretty significantly. Nvidia had a good week. Meta had a really good week. Oh, my puppy dog has joined me. Hey, Charlie, what you doing over there? He decided to tear something up. I should probably go check that out. All right, I'm back on record. So what happened was, here's a little behind the scenes. I had this little fan that I use in my office, and apparently it blew off this insurance document. And Charlie's a cavapoo. He's a little over a year old. He started shredding it for me. Confidentiality. Anyway, so as I was saying, Meta up, energy was up because oil prices were up a bit. Tesla down, industrials had a tough week, and by and large, software had a tough week as well. So, but nothing too remarkable there, one way or the other. So, one of the things that I teach is how to build a stock portfolio. And I teach people how to be able to do these things on their own. And I spend a fair amount of time, beating up all the quote unquote advisors who want to manage your money. And I tell people, you're probably paying for nothing. And a lot of you, I'm sure, are. I actually have one money manager. He's the only one that I ever recommend people to. If you have an interest, shoot me an email. But percentage of actively managed US large cap equity funds that outperform the S&P 500. Last year, it was 21%. Think about that. 79% of these quote unquote professionals, people are paying, 1 to 1.5% a year to, which can amount to millions of dollars in comp, got a rate of return less than what you could have got if you just bought the SPY and sat on it. That is disgraceful. And year to date, the percentage that's outperformed is 25%. You can go all the way back to '09. There's not one year where half of them got a return higher than the S&P 500. How about in 2021? 15%. 2014, 13%. 13% of the professionals got a return better than market average. So if you think that Wall Street is there to make money for you, you don't understand. They use you to make money for themselves. That's the deal. And most people haven't figured out the game because all you see are the fancy ads where the advisor is so polite to the client and here's what your future is going to look like, and you're going to spend eternity on the beach and fishing and walking your little French poodle, and we're going to make all of it happen, and we take a personal interest in you. And you see the ads and go, well, it's on TV, it must be right. and look at their nice offices and you know the brand names, and these people suck. There's no incentive for them. They just want to gather all the assets that they can, sell you their story. You pay them year after. I mean, if you're paying 1% a year in management fees, think about this. 25 years down the road, 25% of what was in your account is now in their pocket, including if they lose money for you. And as you can see, including if they underperform market averages. Wow. Fund managers, many of which are just throwing in the towel, they've stopped actively managing and now they're passively managing, which means they're just picking a portfolio, sticking with it through hell or high water, showing absolutely no aptitude for timing and research. 53% of funds are now passively managed. Look at 1993 when these people actually used to get paid to do something. Almost 100% were active and 0% were passive. Now it's 53% passive, 47% active. It's a disgrace the way that industry operates. Warren Buffett's old company, Berkshire Hathaway, and I'm sure Mr. Buffett still has a lot of influence over there. I hope he does. Look how much cash they're stockpiling. They're over $400 billion in cash, which is pretty damn defensive. So I think, and Buffett's always been willing to do this in times of uncertainty, kind of ride it out on the sidelines, build your cash position, and be ready to strike when there's some clarity in the marketplace. Not a bad strategy. So, what are the earnings expectations now that we are getting ready to move into earnings season? So, for the next 5, 6 weeks, earnings and earnings news is going to dominate. I mean, in theory, earnings should be the only thing that really drives the market. It's not how it works in practice. But as a company's earnings go up, their value goes up, their stock should go up, right? So for all S&P 500 companies, we're expecting year over year earnings at 23.6%. Why do you think the market's up 10% so far this year in a little over half the year? It matches what's going on with earnings. Now, if they underperform, so I was looking at a study when companies last quarter got an earnings beat, their stock went up on average 1%. If they had an earnings miss, their stock went down 5.6%. So it's those misses you need to be careful of. Market sentiment improved from July 1st to July 8th. I told you that was going to happen. So bullishness sort of got back in alignment with historical averages. So on the 1st of July, when independent investors were asked whether the market would go up, down, or sideways for the next 6 months, 31.4% said it would go higher. Well, the historical average to that question is 37.5% say it'll go higher. Well, now we're at 36.3%. Now, after this deal with the Strait of Hormuz, and now apparently we're back at it militarily with Iran, you're going to expect to see that go down on the next print. Hopefully, we get some resolution, but I've been saying that for 3 months. So apparently, my hope is not being felt anywhere. On the last print, 37.2% of investors said that they believe the market would go down over the next 6 months. So that's kind of a push. 36.3% bullish, 37.2% bearish. Historical average 37.5% bullish, 31% bearish. Fear greed index, I think, is right where it ought to be, on the tip of fear. I think as I look at the market and I look at geopolitical events and I see what's happening with oil prices and interest rates, I think that we should be a little nervous about things. I think I think any reasonably well-educated investor would go, you know what? There are some exogenous risks out there that I need to be paying attention to. So sometimes I agree with the index. Sometimes I think investors overdo it. I think they're spot on. They're not deep in fear, right? I mean, one more notch over, we're in low neutral. But I think that's appropriate for where we are. The future of interest rates. So this has changed since the last time I was with you. For those of you that can see this on your computer, great. If you can't, I will articulate it for you. But coming into this year, we were expecting two rate cuts. Well, then we go to war with Iran. Oil prices shoot up, inflation shoots up. The Fed is now going to have to more than likely tighten. And even since last week, there's been a pretty big change. Last week, there was a 75% probability that at the next Fed announcement on July the 29th, that there'd be no rate cut. That probability is down to 61%. I still don't think we're going to get a rate increase on the 29th. But there is at present a very high probability of a rate increase in September. I think the market's expecting it. May cause a 2 to 3% pullback. There's going to be some response from the market, and it will be negative. There are some analysts I know who I'm familiar with holding out hope that this will get postponed, but uh, I think it's inevitable. September, October, especially if oil prices stay elevated, the Fed's going to have to do something to control inflation. Unfortunately, we're expecting a second rate increase in December. Now, December's a way away, so I'm not going to make too big of a deal out of that. A lot could happen between now and then. Two rate increases this year, I think, will stall this bullish market. One rate increase, I would believe that we'll hang on to the gains and maybe add a little bit to them. So, we're up about 10%, well, less than that after today, but we were up about 10% on the S&P year to date. If we get one rate increase, I think maybe we get to 15%. If earnings are as good as we hope they will be, we get two rate increases, it will be tough for the market to finish in double digits. So that's the latest. Next week, this could look very different. Sector performance, year to date, S&P up 10.19%, led by energy. I throw that out because that's all war-driven, not business-driven. Tech up almost 18%. It's fantastic. We're barely more than halfway through the year. Industrials, what is that from? AI data centers. Up 16.64%. So the laggers have been consumer discretionary, so it's down 1% for the year. Financials, which were down recently 5%, are now up 2%. So they're starting to make a bit of a comeback. So big winners, tech and industrials compared to the S&P. The big losers, discretionary financials. Communications been making a comeback, but they're up 4% when the market's up 10%. This week's earnings. So before the bell on Tuesday, we have JP Morgan, Goldman Sachs, Bank of America, Citi, uh, Wells Fargo. That's going to be very telling because each one of those companies is going to come out and talk about um, how the consumer's doing. On Wednesday, ASML, Johnson and Johnson, BlackRock. BlackRock is going to be interesting. Um, PNC Bank, after the close, United Airlines. So we'll get to hear about travel. Thursday, we have a couple of IPOs. By the way, speaking of IPOs, have you noticed? In fact, let me give you a current number where we are with SpaceX. It is at 138.67. So it was after the IPO, it was first available for $1.50 a share. I told you my expectation was we'd see a big pop in the price because of all the pent-up demand, and then people would start looking at the numbers. Stock would come back down to earth. Now we're at 138. So the people that got in at 150 are now down 12 bucks. I'm telling you, the way to play these, give them 6 months. Now, if you can get in pre-IPO at a lesser price, that's a different deal. United Health, Taiwan Semi, GE, Abbott, US Bank, after the close, Netflix. Man, I hope they have something good to say. And then on Friday, Traveler. So fairly active earnings week. News of the week outside of earnings. So these would be news events. Um, Today, nothing that's going to move the market. Tuesday, we got some interesting stuff coming out. First of all, we're going to get the NFIB index of small business optimism. How do small business owners feel about the economy since they deal with the public day to day? We get the inflation numbers coming out. CPI will come out for the month. And then we're going to get year over year CPI and core CPI. So core CPI is the consumer price index minus energy and food. On Wednesday, we get the latest numbers on manufacturing in New York, and we get PPI. So PPI is inflation at the wholesale level. We're going to get personal consumption, see how consumers are spending money. On Thursday, retail sales. We got the Philly Fed Business Outlook Survey, weekly jobless claims, housing market index, and nothing on Friday that's going to move the market. I mean, the next University of Michigan um, consumer sentiment number will come out. So, I mean, you talk about a week to be keeping an eye on the data. This is it. Check in with that on a daily basis. All right, let's take a look at the charts. Everything is in the charts. Let's pull up the SPX, which is the S&P 500. So those of you that can see this, I'll explain what you're looking at. If you can't, I'll give you a verbal picture. So we're looking at a 6-month chart where we see the S&P for a couple of months was moving sideways. Then we went to war. The market fell. We had the ceasefire announcement. The market went up. And since about, let's see, June 2nd, the market's been rolling over, recovering, rolling over, but the highs are getting lower. And that is significant. Now, the lows are getting higher. So, what we have forming, my friends, is a wedge pattern. If you draw an upper trend line, as I'm doing, and a lower trend line, you have a wedge. Wedges are typically precursors to a big move, either to the upside or to the downside. Now, everybody wants to know in advance which way it's going to move. Nobody knows. But wait to see if it breaks above the upper trend line, then the market's going higher. Below the lower trend line, market's going lower. So this is something to keep an eye on for sure. How about the Qs? I like the fact we're still above, by the way, the 50-day moving average. The Qs are sitting right on their 50-day moving average. So this is a pretty important point. Over the next couple of days, we need the Qs to get a little boost. Otherwise, they could be a bit vulnerable to a move down. And how about the VIX, volatility index, commonly known as a fear index? When the market goes down, the VIX generally goes up. And that's what's happened today. The VIX is up 11%. So we were hanging around 15, which is a very low level. Now we're at 1668, which that's not bad. It's still below its 50-day moving average, but definitely a pretty big move up from where we have been as of the last trading day. So my partner and I put out trade ideas of the week on a daily basis. And I'll talk to you about if you're interested in a service like that, if you're an option trader. We closed one last week on NVIDIA. So this was a call spread. Our short strike on our call was 190. So basically, we were betting that between the time that we put this trade on and closed it, that NVIDIA would stay above 190, which it did. To protect our downside, we also bought the 187.50. July 8th was the expiration. We had to make in 24% on that in 8 days. Pretty darn nice. I know we had another one. Let me check this text. On Apple, we actually had a potential loser on our hand on a spread trade that we did an adjustment on. We ended up making 12.8% in 22 days on that one, but that one was just flat headed for a loss. So, if you're interested in a service where you're getting, and only do this if you understand options, but you can go to TradeIdeasOfTheWeek.com. There's a little video that explains the service. Our track record is right below that video, and I think the track record for the last 3 years will positively blow you away. All right, so I had two stocks. Somebody wanted me to look at for them, Oracle and Nibius. So let's go ahead and do that. So first of all, I'm going to check these out on Yahoo Finance. Okay, so here's Nibius, which is down 10% on the day. That's a pretty big hit. So the little write-up on it, Nibius is experiencing notable attention from analysts following Amazon's 20% GPU price increase, which may drive demand for Nibius cost-effective AI cloud solutions. Despite a 345% year-to-date gain, concerns linger about competition, valuation as market dynamics shift. So there's some worry that this might be a little ahead of its skis. So the stock is trading right now for $209 per share. Average volume per day is 17 million shares, so plenty of liquidity. Market cap, which is the number of outstanding shares of stock times the price per share, 53.8 billion. The beta, the volatility is 1.4 times the volatility of the S&P. So you have a fairly volatile stock here. The PE ratio is 81, and that's the trailing PE, that's high. Earnings per share estimate $2.59 for the year. Next earnings date will be August the 6th. So that's kind of the rundown. Let's take a look at what this looks like on a chart. M, oops, NBIS. So we see a stock that has, for the last 6 months, been on a pretty nice run with higher highs and higher lows, very bullish, was trading in a range. 6 months ago it was at 100. Now it's more than double that. Then the question always becomes, can it continue to support that price? Earnings haven't doubled. So the stock topped out over here at almost 300. Since then, it has come down significantly from 298 to 208. It's dropped $90 a share. It's lost 30%. And as you can see, it is now trading below its 50-day moving average. If it were me and I were interested in this, I would want to see it make a base, set up a level of support, and then I might have an interest, but not until it crossed back above its 50-day moving average. Also, the volume on this kind of fell off. They ran out of buyers, is kind of the long and the short of it. The other stock was Oracle. So Oracle is kind of lumped in with, all things being software. So the only positive thing as you look at this chart is that the current price of Oracle, it is sitting at a pretty significant level of support. So I think the worst is over for Oracle. If it can hold this level, that's if, capital I, capital F, if it holds this level and maybe starts to form a rounded bottom, I think that's a great opportunity for either a call spread or a call option. I would like it a lot at that point. Now, just as a little learning exercise, you see where Oracle, over a period of about a week, had almost a parabolic rise. If you've watched my podcast before, you've heard me say a parabolic rise always leads to a pullback. They are not sustainable. You'll never see a stock continue on that kind of a trajectory, ever. So it did exactly what we would expect. Now, the fact that it fell that far, I mean, this stock was at a high of 250. It's down to 134. But at 250, man, that's when you should have been ringing the cash register. We got into overbought on the RSI, and then shortly thereafter, the MACD turned red. And that combination is death for a stock. Overbought with a red MACD, that stock is going down almost every time. But now it's made its move down. So I think at this pricing, assuming it holds, I would definitely have this on a watch list. It holds here, the stock is going to go higher. I'm just telling you. So, again, for those of you who can see this, awesome. If you can't, I will articulate it for you. If there are things that you want me to talk about, topics, questions, stocks, happy to do that. Shoot me an email at stevesitkowski@gmail.com. That's Steve sitkowski@gmail.com. Fantastic. I always love doing these. Hope you enjoyed listening and learned some things that'll be of value. And I'll be back with you next week. All right. Until then, be safe, be blessed. Bye for now.